Accenture, stock ticker ACN, has a solid financial foundation, minimal debt, and a commitment to returning capital to shareholders through dividends and stock buybacks. So far year to date, they are up around 13.5%. Zooming out a little bit to 1 year, the trend continues, up around 19%. They did recently release their earnings report where they actually missed on the top line but beat on the bottom line. And in the same press release, they also announced they were raising the dividend by 15.2% to 1.29 and also adding $4 billion to the repurchase program. So it's now approximately $6.5 billion. If we jump into the dividend stats, you can see here they do offer a dividend yield of 1.68, annual payout ratio of just over $5, a payout ratio of around 40%, and a 5-year growth rate of around 11%. They've only grown their dividend for 3 years, but if you take a closer look at that, you can see here, yes, they have indeed only grown their quarterly dividend for 3 consecutive years. But if you take a closer look here, it actually had a semi-annual dividend before, which ended up at 1.46 before they changed it to quarterly payments instead of biannual ones. So if you sum all these quarterly payments together, you actually end up with a higher amount than the semi-annual one. So they did actually increase the dividend. They just changed the payment schedule. So again, it needs to count from the start. Even though it says 3 years, it actually is a longer streak they are on right now. As mentioned, they do have a very nice financial foundation. You can see here the revenues are just going one way, and that is up. Back around 2019 in August, they had $43 billion. Last report, August 23, $64 billion. And if you come down here as well to the net income, also rising 4.7 up to around 6.8 from the last report. And also coming into the cash flow statement, you can see here as we start with the net income, obviously we just want to go down here to take a look at the cash flow operations and see the capital expenditures. As you can see, they have been pretty steady over the last couple of years, around 600 million 4 years ago, and around 528 now. And the cash flow operation have steadily risen as well, 6.6 up to 9.5. Coming down here in the bottom, we want to see the free cash flow per share. As mentioned earlier, the dividend per share was just over $5. And as you can see, the free cash flow per share is around 14. Plenty of room to raise the dividend in the future. Before we jump into our own stock valuation models, we do want to take a closer look at what the analysts think about the stock. They do have it rated at Wall Street as a buy. You can see on the right. Plenty of analysts actually has it as a strong buy, but also a lot of them has it as a hold. Only one on the sell side, so it is looking pretty good. But if you come down here a little bit, you can see here average price target 335, only a 9% upside from the current level, so not really a huge upside right now. But as you can see from the start, they have actually also over the last year risen quite a bit, and we have actually been pretty close to the price target from the analysts. But jumping into our stock screener, zooming in a little bit so we can see everything a little bit better, we do want to take a close look at some of the dividend stats and also the valuation and some of the key metrics. As you can see here, I mentioned earlier, they do have a pretty nice minimal debt. You can see net debt to EBITDA ratio is actually negative, meaning they have plenty of money on hand. Also, return on invested capital, return on equity, really nice steady numbers here. I really like to see it that way. Operating margin looks pretty good as well, and the actually 5-year average is looking, the operating margin is a bit below the 5-year average, but that is looking extremely well. So I think this is maybe just a transient year due to the economic environment right now. They have actually grown the operating margin over the last 5 years, 1.6%, also looking extremely good at a 10% profit margin. Current yields mentioned as earlier, this probably puts an old number in, but the most important thing is the dividend growth rate sits around these 9 to 10 to 11%. Coming into a dividend data tab here, and if we zoom even more so we can see everything more, you can see here they actually had quite some steady growth, and that is definitely what we're looking for. As you can see here, they actually looked like they had a pretty big cut at some point, but as mentioned earlier, if you remember, they actually changed from semi-annual to a quarterly payment. So what we want to take a close look at is actually the last couple of years where they have kept this steady around 10% growth, and over the last 10 years, you can see the growth rate is also sitting around 10%. Nice dividend growth stats. Coming down to the dividend yield theory graphs, you can see here that the dividend yield theory at least could actually indicate that it is a little bit undervalued, around 6%, as you can see on the graph on the left, ever so slightly here. But obviously we also do have a lot of different valuation models. I don't want to go through every one of them, so I'll just go through here and you can pause if there's anything you would like to take a close look at. I want to say the dividend discount model, I will exclude it because the dividend growth rate is so much higher than the weighted average cost of capital, so it will give up a negative number. And you can see we also have multiple variation, Graham's Vice, PE, free cash flow variation, the Peter Lynch model. And before we jump into a summary, thank you so much for watching. And if you've come so far already and not subscribing to the channel, please do so for more videos in the future. Now let's jump into a summary where we do have are all our valuation methods summed up here. As you can see, I've chosen to exclude the dividend discount and also the Peter Lynch valuation model, mainly because the Peter Lynch model is so far off in this specific case that I don't really want to include it. And as mentioned earlier, the dividend discount model is negative. If we do take the remaining ones, we do end up at an average intrinsic value of $273. With the current price being around $307, it's actually overvalued by around 12% at the current time. And that is where our margin of safety calculator over here on the right comes into play. We start with a standard of 25, and depending on some of the key metrics, we either add or deduct a margin of safety. So you can see here, in the end, we actually end up at minus 10%. So that means that we probably have a stock on hand that is of such a high quality that it warrants to actually pay a little bit of a premium. So if we come over here and actually punch in negative 10%, meaning that we would be willing to pay a 10% premium on top of the average discount, on top of the average intrinsic, which means that the acceptable buy price becomes around 301. With the current price being around 307, it could actually indicate that it's fairly valued at the current time. I do want to say I've never really looked further into Accenture, but based on this, I really feel that this is a quality company, and I will definitely make some more research based on just this video. Thank you so much for watching, and I'll be seeing you in the next video.